All right, let's jump right into this explainer. For the longest time, the narrative around fintech has been pretty standard, right? Just a bunch of scrappy startups burning piles of cash to try and disrupt legacy banks. But the data we're looking at today proves the industry is growing up, and it's growing up fast. We're going to examine one single truly massive day, May 15th, where three major events fundamentally shifted the landscape of modern finance.
To really put the scale of this into perspective, think about the split screen of what was happening globally that day. On one side, you had world leaders shaking hands in Beijing, doing the traditional global diplomacy thing. But on the other side, stateside, fintech was executing its very own brand of high-stakes diplomacy. We're talking billion-dollar earnings reports, massive artificial intelligence checkout deals, and completely historic Senate votes. While the world was glued to geopolitical trade deals, the actual plumbing of how we buy, sell, and trade was literally being permanently rewired.
I mean, the source material just absolutely nailed the mood of the market that day with this quote. It's giving Succession finale energy, everything happening at once, everyone trying to win. That captures it perfectly. The sheer scale, the rapid-fire chaos, the monumental stakes of what went down across the sector in just 24 hours. Everyone was making their big move.
So to make sense of this massive shift, we're breaking it down into three pillars today. 1. Klarna's profitability at scale. 2. Affirm powering AI commerce. And 3. Coinbase winning Washington.
Let's start with pillar number 1, Klarna, profitability at scale, and how buy now, pay later is finally silencing the doubters.
For years, skeptics pointed at the buy now, pay later model and basically dismissed it as a zero interest rate phenomenon. The assumption was it just couldn't be profitable. Well, the velocity of this turnaround proves otherwise. Klarna reported Q1 2026 revenue of $1 billion. That's a massive 44% jump year over year. But the most vital piece of data here, swinging net income positive for the first time since early 2025, hitting $1 million. Adjusted operating profit also surged to $68 million, up from just $3 million a year ago. Unsurprisingly, the market reacted instantly, sending the stock up more than 13% in pre-market trading.
And listen, this isn't just some clever accounting trick or aggressive cost-cutting. It's the underlying scale actually driving the bus. We're looking at 119 million active consumers, operations across more than 1 million merchants, and gross merchandise volume hitting $33.7 billion. Like CEO Sebastian Siemiatkowski noted, this success is driven by a growing network, much deeper consumer engagement, and the exact same core products. They didn't reinvent the wheel, they just scaled it beautifully.
Which brings us to this absolutely incredible number, $1.4 million. That represents Klarna's revenue per employee. It has nearly quadrupled since 2022. When you compare that level of pure operational efficiency to other Silicon Valley unicorns, it makes the rest of the pack look incredibly bloated. They are pumping out massive output with a highly optimized team.
So, the crucial takeaway from this first pillar is that Klarna officially hit the reset button. Despite the stock having a pretty rough start to 2026, this print proves the operating model absolutely works at scale. Klarna's story is no longer just a growth story. It is definitively, undeniably, a profitability story. And that entirely changes how investors are going to value this subsector.
Moving on to Section 2, Affirm powering AI commerce and wiring into the shopping stack.
Now, if Klarna proved the model works today, Affirm is out there wiring itself into how we are all going to shop tomorrow. This is the new, completely invisible consumer experience. Affirm announced that their pay over time options are going to be embedded directly into Google's search and the Gemini app via Google Pay. Just imagine this. Your AI agent shops for you, connects via Google Pay, and Affirm seamlessly splits that purchase into 4 payments before you've even typed a single word. Talk about completely frictionless.
The real technical magic making this possible is the Universal Commerce Protocol. This is the open standard for agentic commerce, co-developed by heavyweights like Google and Shopify. And Affirm, they're building built-in buy now, pay later extensions straight into this standard. By embedding deeply into this protocol, Affirm isn't just picking up a new distribution channel. No, they are building a massive structural moat. Wherever AI agents go to shop in the future, Affirm wants to be the default way those agents pay.
Just let the sheer scale of that ambition sink in for a second. $150 billion. That staggering figure is the projected gross merchandise volume for the Affirm card alone. It's based on the math of 20 million users spending an average of $7,500 annually. CEO Max Levchin laid out a roadmap aiming for $100 billion in overall annual GMV, which implies a massive 25% plus annual growth rate from exactly where they are sitting right now.
The source material uses this hilarious but honestly incredibly accurate metaphor to describe Affirm's momentum right now, like Marshawn Lynch running through the entire Saints defense. It's not subtle, but it works. Google essentially just handed Affirm the keys to become the core infrastructure for the AI commerce era. They are just overpowering the field, embedding themselves so deeply into the tech stack that they literally become unavoidable.
Finally, Section 3. Coinbase wins Washington and crypto finally gets a lane.
For years, the crypto industry has been operating in this murky gray area, fighting just endless court battles. But on that exact same day in May, the Senate Banking Committee advanced the Digital Asset Market Clarity Act with a decisive 15-9 vote. Why is this such a big deal? Because it marks the most significant piece of crypto market structure legislation to ever clear a Senate committee. It's a massive milestone, and it sent Coinbase stock surging more than 8% almost immediately.
The industry was paralyzed for years by a brutal turf war between regulatory bodies. The core impact of this new legislation is finally bringing some clarity. It draws explicit lines breaking down exactly what falls under the CFTC's jurisdiction as crypto commodities and what falls under the SEC's jurisdiction as crypto securities. You can actually build a compliant business now, knowing exactly whose rules you're supposed to be following.
But getting to this point, absolutely not easy. The journey was a dramatic one, aptly called the legislative crawl. Back in January 2026, a massive fight over stablecoin yields threatened to derail the entire bill. It got so bad that Coinbase CEO Brian Armstrong actually pulled his support at one point. But thanks to a critical compromise brokered by Senators Tillis and Alsobrooks, he was brought back on board, paving the way to that successful May 15th committee vote. Now the big target is getting it signed by the White House by July 4th. For an industry that has burned millions of dollars and countless hours battling regulators, this quote just beautifully captures the relief of securing a legislative lane. Today felt like the Shawshank Redemption, a long crawl through a very dirty pipe to get to something that looks a lot like freedom. The industry is finally stepping out of the shadows and getting real federal recognition. So let's pull all of this together. You've got Klarna proving the model is scalably profitable, Affirm becoming the invisible AI infrastructure, and Coinbase securing federal recognition. It paints a crystal clear picture, doesn't it? Fintech has matured, adapted, and integrated to the point where it's no longer just trying to break the system. It has become the system itself. Which leaves us with one massive question to consider as we wrap up this explainer. As Fintech shifts from being a scrappy disruptor to the profitable, AI-driven, and regulated infrastructure of our daily lives, how are you going to adapt to navigate this new financial era? The plumbing of the global economy just got permanently rewired. The question isn't if you'll use it, it's whether you'll let it manage you or if you'll learn to master it. Keep learning, keep adapting, and I'll see you in the next one.